I downloaded the Google financial statements from a site out there, investor.google.com. In fact, this seems to be a standard format. You can put investor.ibm.com and so forth. And if you search a little bit, you can find what is called their 10K reports, which is the reports they file for the Security Exchange Commission. It's a list up here. It's an official organization, and this is the one that watches over the stock markets and so forth. And this, they file quarterly reports and annual reports and so forth, and very extensive. We go to the table of contents. What we want to look at the financial statements, supplementary data. There's a lot of stuff here which I think very few people look at. And here's balance sheets, income statements, cash flow, the three things we talked about. Let's look at income statement. Here they are. The data that you look at in the income statement. What I do with these is usually take them. You can shade. I can get the shade correctly. This is the beauty of Excel. If you have a table on a website of almost any sort, you can copy it. Right click, copy. Let's go to our spreadsheet here, do a paste, and there it is. Now it doesn't look quite the same, but that's because there's some real formatting problems. If I move this over, and now we got rows that are all different sizes, so I'm going to just shade a couple to show you what it's going to do, then I'll do them all. Format, row heights, we'll make them all 15. Now we got a bunch of others that are still bad, so let's just do them all. Shade down. Format, row height, 15. Okay. And there's our statement. These are formatted a little bit differently. We really don't need this column B. We can delete that. We can delete these two if we wanted to. And get it over there so it's workable. The point I'm trying to make is that you can take this off the web and do some analysis and work with it what you want. Here is 2008, 9, and 10. Maybe I only want 2009 and 2010. There I have them. And you can do a lot of adjustments here. And in this week's content, then you saw a, let me try and get to it, Google income statement. Here's that one, and I reformatted, took out, ended up 2009 and 10, and here's the categories. Now Google has a little bit different categories than you see some places, in part because up to this year really they were almost totally a service organization. They did not make products, so they did not have materials or cost of goods sold to speak of. And so they reorganized their statement a little bit different. If I reorganize that over here into a very standard form, there's revenues 23,651, I moved them over here and so forth. Cost of goods sold is a standard thing. That's just cost of revenues basically. So move that over here, and there's a gross called the gross profit. And then they have what is called sales, general, and administrative costs in an income statement. So I took categories from here and moved them over here, the numbers, and summed those up. That's the total of the sales, general, administrative, commonly referred to as SG&A. And if you take this gross profit, add in a negative cost, 6,495. The earnings for interest and taxes are 8,312. I say 8,000, this is in millions, so that's like 8 billion. They earn some interest. You might say, why is interest here and not up under SG&A? SG&A are all costs related to the products they sell, the services they sell, and so forth. Interest is something different. That they didn't earn that because of what they did in offering their product. That's because they had money sitting in an account that drew some interest on it, and so forth. They had even more in 2010. But it is income. So we add 2 and get the pre-tax income. And then you put down your income taxes and get your net income. From this you can see that the 1,008 over 1.8, almost 2 over 8, about 25% tax rate for them. We could figure out exactly equals a minus L21 over L20. Oh, that was a minus. I didn't have to change it to a minus. They paid about 25%, it looks like, in this year, which is high for a lot of corporations now with all the deductions they can get. The maximum rate is 35% now, and some do get up there. But anyway, you can format these in various ways. This is consolidated statement of income. One thing you can do with these is get what's called a common size statement of income. If you divide every number on this by 23,651, this becomes 1, this becomes a proportion of that. You can see that here. This is 100%. Our cost of goods sold, that is 36% of our revenues. And you go all the way down, our net income in 2010, I believe this is, yes, is 29%, which is very, very good. That's why Google's profitable. So the common size statements are a valuable thing to use to get per percentage. With that, you can compare to other companies, see how they're doing against Microsoft, against Apple, and so forth. Companies in their same industry, and see how well they're being managed. Let's look at the Google cash flow statement. Google Consolidated, again, here is all the detail, more detail than a lot of people want to see, although someone that's really into this might look in detail on that. I'm sure their competitors probably do. Here is operating activities, the net income. On the previous one, income statement, 8305 was the net income. That starts off our cash flow. We have to add back in depreciation. In the income statement, we took out, in the common size, let's move up to, here's depreciation, 1067 in 2010. And interesting, they didn't have any in 2009. We add that back in. Cash is not, depreciation is not paid to anybody. It's just there to get a more accurate income statement as to how you were doing in a particular period. But the cash doesn't flow, so we add it back in. We add it back to the net income. They have some other, which is a number of categories I just lumped together. And so the operating activities, 11,180, which I think there's a comparable number, 11,081. Did I say that? They aren't the same. But they do have the right number down here. 11,081 does compare with this over here. Have me stop for a minute there, but these accounts payable, receivable, and so forth are included over here, and that isn't included in there, but it is here, so the number did come out the same down here. Capital expenditures are cash. They purchase property, equipment, some acquisitions, other investments, over 10 billion. Say this right. It's put into there, which comes out of the net cash. They did some other financial activities, bought, sold stock, or whatever. I'm not sure what those are. It's in the statement somewhere. Every one of these has details. And cash flow over the year, they increased the amount of cash in the company by 3,432 million. At the end of the beginning of the year, or the end of 2009, they had 10 billion and some. They add this almost 3.5 billion, and they end up at the end of the year with cash of 13,630 million. That is the cash flow statement. We can go to the balance sheet, and you might start at the top, cash and cash equivalents. Here's the two numbers that we just saw. They started over 10 billion, ended up with 13, and that's the numbers which they compare with these other statements. Again, I reformatted these in the more standard condensed form. These are already consolidated, they call them, but these are consolidated, if you wish. No inventory. It's interesting. Some of these, it's how it is different because it's a service company. And so the current assets, they have cash. If they had inventory, there'd be some there. When now that they have a Motorola division, they will start to have inventory. Money owed to them is right here. That's an asset. People owe you money. And the other is a whole bunch of other categories I lumped together. So total current assets, we have the years up here. End of 2009 was 41 billion and 29 here in 2009. It's increased substantially. Long-term assets, that's like buildings, land, and so forth that couldn't be sold very quickly. These are called current assets and long-term assets. If you look at these, you can see the difference. So you get a total assets of these numbers down here. Then there's liabilities of stockholders' equity, accounts payable, money you owe people, short-term debt, bank loans, whatever, and they have a large category of other. You can go through and get the detail. These are liabilities. And then there's long-term, stock, owners' equity, stock, retained earnings, and other. Put those together. And you add these three numbers, actually these four numbers here, you get 40,497,000,000, which is the same as this number up here for 2009, 2010, or do I have that backwards? That's 2000. December 31st, this has to be wrong, one has to be 2010. I don't know if I changed it incorrectly or if it's wrong, some statement. But there's your numbers here. You compare the 2 years. The next aspect to help investors of all sorts to look at companies, I've copied over some data from the previous sheet. If you look at this, current assets 41,562, it came from their balance sheet. If I go back to this tab down here, the balance sheet, in K16, I go up to C16. Here are the current assets total. Okay, this is 2010, that number there. So the ratios, I simply, you go to here, I'll take it out and start over, put in an equal sign, switch to the balance sheet, go to where there are current assets, right there, click on it and you see it copies it in for you. Hit the enter key and you're back here and there's your number. All of these came directly from those other statements, they're linked. What people do and what's needed is, Google is one size organization. If you want to compare it to another one that's very much larger or smaller or whatever, you often compute ratios. And ratios just to see how a company is doing. Liquidity, how do they have enough money to pay their bills in the next year? And you can get current assets over current liabilities. They have 4 times the assets as liabilities, so they're in really great shape. And that gets down close to 1, you have problems. Quick is the very assets, current assets can be turned over very quickly. Cash, accounts receivable, they count as current assets. You can get those quickly. And there's current liabilities. And you can, those numbers I've listed up here, these are all taken. C4 plus C5, that's these two categories, C4 plus C5 divided by C7, and you get the quick ratio, which is, how are they in the very near future. And again, if these dip below 1, you're typically in trouble. You better take care of it in a hurry. And all the other ratios, these are discussed in the textbook. I'm not going to go over all of them again, and they're discussed in the content. So look at those. The data all comes from these 3 statements, the income statement, the cash flow, and the balance sheet. From those, you can compute a whole variety of ratios. These are the most common ones. Probably every investor has their own little ratio they want to look at to give them an idea what the future of the company is going to be. Is it worth investing in?